Hey, it's Soleil, and this is episode 91 of the Orange Pill Investor. And today I want to talk about what is the best investing strategy. And to do that, I guess I'm probably going to have to talk about what is the worst investing strategies. And as far as I can tell, buy and hold dividends are just terrible. So I sell covered calls, and it's funny because some people will even say that I'm trying to pick up pennies in front of a steamroller. And I don't know what these other trading philosophies these people are using, but they never seem to be able to show you the returns or demonstrate this magical stock picking philosophy that they have where they just buy and then they just go to the moon. Generally, the people who are serious will just say, get a good job, be a workhorse, work 9 to 5 your whole life, put 10% into savings, passive index fund, or dividends, whatever, and then retire a millionaire. And that worked fine for our parents, grandparents probably. They could just buy a house, that would appreciate. I don't think that stuff really works anymore, not with the level of inflation that we have available, and certainly not in light of the other tools that we have. And before I even talk about covered calls, if you're saving and you're not saving in Bitcoin, then you are shooting yourself in the foot. So let's just start there. If you don't have enough Bitcoin to save your bacon if you need to flee the country, then step number one is go get some, get off zero. But if we're just talking about the stock market in general, you either have to put money into the stock market or you just like it. What's the optimal strategy? And so the way that I'm going to look at it is like this. If someone offered you a savings account and they were, instead of the 0.5%, or I don't even know what the savings interest is now. I just know that it amounts to like 11 cents a month or something stupid. But whatever that percentage is, 0.5% a year, 1% a year, I think when I was younger, I got 3% or maybe something like that. And I always had this idea of, okay, when I retire, if I have $1 million and I get 5% a year, that's $50,000 a year, and I can live on that. But if someone said, hey, I got this savings account, I got a CD or whatever, and it's 52% a year, and it was like legit. I mean, it's not like, oh, it's too good to be true, it's a scam. I mean, the bank was like offering it to you, 52% a year. Anyone in their right minds would just jump at the chance. Or what if there was dividend stocks and they said, okay, dividends are going to be 52% a year. Would anybody be interested? So if you answered yes to that question, then congratulations, because you are an option seller. I sell covered calls against shares of stock. And when I say 1% a week, I'm being very conservative because I don't want to I want to underpromise and overdeliver. 1% is like baseline. So I generally get 2%, 3%. I've gotten as high as 10 to 15% before, but that was like just really, really dumb trades, very risky trades too. Like when the GameStop short squeeze was going on. But some of those things are they're just fun, really. But serious investing, 1, 2, 3%, 5% if you want to get really greedy a week, are just routine. These are not unheard of numbers. I just went to Reddit, where I'm sure everything on Reddit is true. But this guy claims he has 1.4 million, and he gets, and I didn't even look at the year of the post, and he gets 43 grand. I already did the math, but I'm just doing this for special effect. $43,000 a year in dividends is what he earns, and he's got 1.4 million. That's 3% a year. Are you kidding me? How am I going to amass $1 million in my lifetime? Scrap and scrimp and save, and I've lived just frugally and thriftily, and my reward for it is I have to sit there and stare at $1 million plus in the bank, and then still budget to 43 grand a year. Now, if your idea of a perfect life is just fishing, and the only thing that you have to pay for is going to be like some tackle and some worms, okay, cool. But I live within my means, but eventually I want a Cybertruck. So if you want a Cybertruck, or you want some cool shit one day, 1.4 mil and 3% dividends ain't gonna cut it. And so just, I mean, this is Wednesday, so these numbers are not going to be completely accurate. But let's just take, which stock is the most expensive this week that I have in this small account? Okay, Mara. I'll look for this week, and then it's Wednesday, so we could probably just double this. But Mara costs you $17 a share. In order to sell a covered call, you got to have 100 shares. If we give the other person, we sell them a covered call, that gives them the right but not the obligation to steal those shares from us at one of these strike prices. So we pay $1,700. If we pick the 1900 strike, that means they'd have to pay us $1,900 for it. So we'd be netting a good 10% profit in 1 week if they decided to do that. The only reason that they would do that is if the price of this went up to 20 or 21 or 22. Now, maybe you'll be pissed off, like, oh, I could have sold it for 20 or 21 or 22. Yeah, you could have, but you wouldn't, because you can't time the market. So when it went up to 20, you'd sit there, you'd sit on your hands, and you'd wait for it to go to 21, but it wouldn't go to 21. It would just go back to 17 or 15, and you'd be screwed. So all of this hypothetical picking up pennies before in front of a steamroller, I just want to wait for it to go to the moon. You wouldn't. You'd sell it at 20 and it'd go to 25, and you'd still be pissed off. So if you're like super trader, okay, you're 1 in a million, but everybody that thinks they're super trader isn't. Most people lose money in the stock market. Even the analysts don't do better than a frickin' coin flip. So this is a mechanical way to sell high, buy low, sell high every single week. I look at it as a compound interest theory, because I'm not just going to get 3% a year. I'm going to get 1% this week, next week, next week, next week, 52 weeks, that's 52%. So let's see how easy this is. If I want to build 10% call away value to make sure that the price does go up, not only do I get this premium, but I'm going to get 10% more on top of it. So I'd have to build $1.70 into this. So that means I could sell the 19 strike. I can get 11 cents. This is Wednesday, so let's just double this. It's probably 22. So for a full week at the 19 strike, I'm going to get $22 for this. 1% of 17 would be 17 cents. So this would be like 1.5% at the 19 strike with 10% call away value. Okay. So $22 a week times 52 weeks is $1,144. That's like 50%. You're halfway to just paying off this stock and you own it for free. A year and a half later of selling covered calls, and this $17 stock that you bought cost you $0. The whole amount is pure profit. Now you're just gambling with house money at this point. I don't understand why anyone is just buying and holding stocks, buying and holding dividend stocks. I mean, unless you're old or you're disabled or something and you literally just can't click this button. I mean, hell, the guy that got the frickin' what did he get put into his head? He's a quadriplegic and he was Neuralink. Yeah, Neuralink. This guy's like playing video games now. This guy, we got quadriplegics out here that can sell covered calls against their savings, against their stock market portfolio, but you can't. This doesn't compute to me. There's no way that you would turn down if your favorite investment, Microsoft or Apple or the SPY or whatever, and let's just look at the SPY. Let's just look. Would you just look at it? So the SPY over a year. Okay, cool. If you bought in right here, I mean, any of these dips, you did pretty good. But over the past year, if you bought before this pump, you made 26% in a year. That's not bad. Which, pro tip, whatever the SPY went up in the past year, that's the inflation rate. CPI came out today, and it was like 3.5%. Yeah, try again. The CPI, the inflation rate should be calculated off of desirable assets, not frickin' Papa John's. The price of Papa John's doesn't go up. The price of Netflix doesn't go up. Actually, some of those value meals I was getting at McDonald's a couple of months ago definitely went up. But anyway, it doesn't go up this much. It's not going up 25% a year. But what about in 5 years? Okay, so in 1 year it was 25%, so you would think this would be 125% over 5 years, but it's only 78%. So yeah, so now it's coming back down to the average. And what is the maximum time? How long ago does it go back? Robinhood goes back to 2000. So this is 24 years, and it's 24 years. It takes you 24 years to triple your money. Are you frickin' serious? Well, that's more than triple. Oh, that's plus. Oh, okay, 377%. Oh no, that's a plus $100. Okay, yeah, sorry, it went up 377. Yeah. So you quadrupled almost. But it took 24 years. That is, and I guess the SPY pays a little dividend or something, so there's going to be a little something extra in here for you. A little bit of icing on your on your 7% a year cupcake. Let's just go back tomorrow. Well, now you know what? Let's go to MicroStrategy. Sometimes I like to talk to these little stocks that everybody can afford. But you know what? Let's trade something that's freaking exciting, for God's sake. If you went at the money, if you double this, you could get 10 grand at the money. Now, there's no call away value in there, and this would be absolute suicide to sell an at the money covered call in MicroStrategy, something that could gap up to 2,000, 2,500, 3 grand in a week. However, I'm just saying. 1% of this 1,500 would be $15, and you can get 3% in half a week. So that's 6% in a full week. If you got 6%, what was that, 300x, 300%? 6% times 52, what is that? Okay, so you could get 300%. Oh, God. Even if MicroStrategy didn't go up, you could get 300% in a year. However, yeah, I mean, you can still go up here just to try to get like, what, like 2%. 2% for half a week, you could get the 1620 strike. So even if this goes up like 10%, no, it's not quite 10%, like 5%, you can get 5% call away value and 3%, 2% for half a week, 4% for the week. I mean, just to make it safer for the call away value, because MicroStrategy can melt your face off. Like if you went all the way up here to 1,700 and left $140 worth of call away value up here, that's still 24, 25 for the week. That's like what, almost 2%. So these returns are insane to me. And anybody who's ever heard of this and doesn't do it might be insane as well. But let's come back down to earth. If you can't come up with $2,000 to play in the stock market, 2,500, you probably should just work your 9 to 5 and save this much, because you're going to play too scared. If you have $1,000 and you get something like whuh, that's $1,000, and then you're playing too scared. You can't sleep at night. But let's just go out to next week. This is going to be a week and a half. But in a week and a half, you can get 60 cents. So what would that be? For just 1 week, it'd be like 40 at 19. That's 2.5%, a little over 2% with 10% call away value. Let me just, I gotta bang the drum on this chart. So this is my chart where I talk about how long it takes to get to critical mass. You get to critical mass when you have enough shares that not only will you collect premium every week, but you can then take that premium and buy another 100 shares. And if you're just targeting a nice conservative, easy to get 1%, it's going to take you 100 weeks buying 1 share a week to get to your 200 shares. And then you're going to sell 2 covered calls a week, and you're going to buy 2 shares a week. And it's only going to take you half the time. It's only going to take 50 weeks this time. Then 34 weeks, then 25 weeks, then 24 weeks, and blah, blah, blah. And eventually, once you have 10,000 shares, you collect 1% interest, you're going to have enough to buy 100 shares every week. This is critical mass right here. This is not a get-rich-quick scheme, even though you're getting rich a hell of a lot faster than at 52% a year than you are at 3% dividends a year. Yes, you're risking unlimited upside, but you're building in enough call away value to still make the upside worth it. If you want to, or you can build no upside and just collect 2, 3, 4%, 5% for the week. Whatever you want to do. But I generally build some call away value in there in case something gaps up, and I don't carry covered calls over earnings just in case something gaps up, or an earnings surprise. So you can protect yourself. You can't protect yourself necessarily from some really good news, like Tesla unveils their $20,000 car or whatever. Okay, you might miss some upside. But once you get to this 10,000, this is critical mass, because now you're not getting 1% a week. You're getting 1.01 plus 1.01 times 1.01. So you're getting 1% on top of 1%. This is when compound interest comes into play. Until you get here, it's additive. It's just 1% plus 1%, which is why it equals 52%. But once you get to critical mass and you're buying an extra 100 shares and you're selling an extra covered call a week, now it goes up to 67%, because the formula isn't 1 times 52, 1% times 52 weeks. It's 1.01 raised to the 52nd power. Whatever your account size is, you're going to have 67% premium collected at the end of the year. So if your account, I mean, in order to get 10,000 shares of something, even whuh is, 10,000 shares of whuh would be like 100 grand. So you're probably not going to be able to hit this until you've got about 100 grand. But once you do, you can buy 100 shares of whuh every week, and you're going to start getting this 67% annual return. So you would be getting, this guy was collecting 43 grand a year on 1.4 mil. And you could get, with a $100,000 account, less than 10% of that, you can get 67 grand a year. This is a no-brainer. And I keep saying I don't understand, because a lot of these guys are just super smart and super dedicated, super frugal. I mean, they're just doing everything right, but it's kind of by the book, and it's the old playbook. I mean, I guess selling options are a little scary. I mean, if you go in here and you're buying calls, you're buying puts, that's straight gambling. I will admit that. You probably will wreck yourself. If you stay on the buy tab, you're probably screwed. You don't want to start messing with this stuff until you actually have a pretty good idea of what you're doing. And there's all kinds of elaborate stuff you can do with credit spreads and different things too, but I don't really tinker around with those too much anymore. I just don't find the need. And some of the people that put me onto options laugh at me because selling covered calls is so conservative. These guys would like be momentum trading, and they'd, watching for this and watch for that, and they'd get in, and they'd laugh at you if they didn't double their money in a day. If they got like 10% in a day, they'd be like, ha ha ha, that's chump change. It wasn't even worth my time. And every day isn't like that. They take some bad beats probably too. So I don't know what their annual returns are. All I know is these guys were just kind of like snicker at me, because even though I'm selling options and people think those are big and bad and scary, they're like, I'm being so ultra conservative because there's no risk involved. I mean, when I say no risk, I mean no additional risk. If you buy 100 shares of Mara, like I actually lost, I bought Mara at $20-something a share? Yeah. So I bought Mara when it was $23 a share, not quite at the top, but I bought wherever it was in here. Like, let's just say I bought it here, and then it just went to crap, right? So if you're a buy and hold person and you're like, I'm in it for the long haul, I'm going to be here for 30 years. Okay, cool. You probably, this will probably turn into $100 a share by then or whatever. But in the short term, if you bought this for $23.08 like I did, and it's at 17, you just lost $600. However, if we look at my history, I sold a covered call at the 20 strike. I got paid $50. I got paid $78 since I bought. This is market sell. I must have had 200 shares. I think I diversified from this. But I sold it for 40. I sold a covered call for 50. So let me just add this up. So like 90, I had to pay to roll. So drop it to 80 and 80, 160. Yeah, so I got paid $200. So the other person is down $600 from 23 to 17, and I'm only down 600 minus 200. I'm only down 400. So the way that I look at it, these volatile stocks like this, when I sell a covered call, every one of these dips is higher than mine. Then I don't go all the way down here, because if I sold a covered call at 20 and got paid $50, then I didn't lose as much. Now, selling covered calls also knocks the top off of these too. So if Mara was here at 22 and I sold the 24 and it went to 31, okay, I got the $200 up from 22 to 24, but I didn't get the 31. Okay, it's no big deal, because when it was trading sideways, I got $50. Well, it was like $10 a share here. So I got, $30, $30, $30, $30, $30, $30, $30, $30. Okay, I missed out on $1 here. It doesn't matter. So I don't have anxiety when the price goes over my strike. The up plan is the same as the down plan. You just sell another covered call for the week after, and since the price is higher, you're going to get 1% off of a bigger number. So down here, you're getting 1% off of $8. You're only going to get $8 a week. When you're selling covered calls up here at the top, you don't know it's going to crash, but you're getting 1% off of 31. So you're getting $30 a week. You were getting 8 here. Okay, maybe you missed some upside, but you're still able to actually participate on the upside, because now you're selling covered calls that are worth more. So this is a no-brainer for me, and I think the way that I asked this at the beginning just frames it perfectly. If somebody said, hey, we're going to give you a 52% annual yield, or we're going to give you 52% on a dividend stock, you'd crap yourself and you would jump at the chance. But yet you won't just take the, I don't want to say it's the easy money. I mean, you have to sacrifice that upside. And I think that's what people hope. They just, if I just hold this, it'll just go to the moon. I got news for you. The SPY is not going to the moon. I mean, that's had some small gap ups here and there, and it's pumped. Like if the Fed lowers interest rates, I'm sure the SPY will pump. But I mean, these mining companies are going to pump more. I'm only trading these mining companies in this small account because I'm a Bitcoin maximalist. So anything that I can do Bitcoin related is what I do. I keep watching the Bitcoin ETFs. I'm like, when are you going to add the options button down here? I'm desperate and just dying to see what the premium will look like on these ETFs. Given the option, I might like to hold an ETF over these mining companies, because mining companies have earnings reports, and you got to deal with that. With an ETF, you wouldn't have to deal with an earnings report. You can just follow and track the price of Bitcoin. So if the premium on these, I just added a couple of them to my list. ARK Invest, I really like. I like their research. Kathy Wood is the only institutional investor that I actually pay attention to. And BitB, I think I heard this one either had low fees or decent management or something. I don't know. I heard something decent about these guys, and at $38 a share. This is still fairly affordable. Who else did I put in here? Did I put the BlackRock one? I wouldn't touch the BlackRock ETF with a 10-foot pole. I mean, maybe the fix is in and maybe they have the best ETF. I don't know. Generally, I'm agnostic about who I trade with, but until Bitcoin cleans up all of the money in the whole world, I'm not fucking with BlackRock. So anyway, that's all I wanted to cover. And maybe I've had this idea in my head of maybe I'll do it when I get, somebody mentioned 800 followers would be a good number to do some kind of giveaway. So maybe I'll try to pump up the account, and when I get to like 800 or 1,000, maybe I'll have some kind of giveaway where I offer 100 shares of whuh or something to somebody who hasn't tried options for the first time. And as long as they, with the stipulations that they trade it the way that I say, choose, not completely with an iron fist, but like, here, choose amongst any of these strikes, and trying to collect 1 to 2%, 3% a week, and then trade that way for like 10 weeks in a row, doing weeklies, and then we could update the progress after 10 weeks and see if how they feel about it, if they think it's hard or easy, and how it compares to buy and hold, and how it compares to dividends, and I mean even real estate. Bitcoin is going to eat real estate lunch. All the investors that I talk to all want real estate, and I would not touch real estate with a 10-foot pole either. I don't need the headaches. I don't need the taxes. When I can just save in Bitcoin, or I can just sell covered calls against shares on easy mode. This takes me like 30 minutes to an hour a week. So when I'm retired, and I actually reached a pretty cool milestone. I'm actually earning more in covered calls than I get paid at my 9 to 5. So I wouldn't necessarily say that I'm work optional, in that I'm desperate to see this continue to grow. So I want to just be able to live off my 9 to 5 and just grow my account. But we've had tons of layoffs. I've survived so many layoffs in my time. I'm sure all of us, our time are up, because we're getting replaced by AI robots eventually. So it'll be interesting to see what the world looks like when all human labor wages are zero or near zero, and there's no jobs. Hopefully we've got like Star Trek replicators to make food for us by then. Otherwise, it's gonna get weird. So yeah, I'm targeting by the end of 2025 to just be work optional, or just literally just go to work every day with no stress, knowing that I can put in my 2 weeks at any minute. I could do it now, but I'd have to tighten up my belt a little bit, I think, because instead of reinvesting all the premiums every week, like I showed in the chart, instead of just selling premium and buying more shares and accumulating more and more and more, I'd have to pay the rent, buy groceries with the money, and then whatever little scraps left over, then I could add to this. So that's the goal. I've been trading since May 2020. I got absolutely wrecked. So from 2020 to 2024, that's 4 years. So it was May 2020. Yeah. 4 years. I did really well for a year and a half, and then I changed my strategy. I wasn't selling covered calls. I was selling poor man's covered calls. And when the Fed raised rates, I got wrecked. This says negative numbers just because I've actually made more than I lost in this account, and I've taken more money out than I put in. So it looks like I actually had negative money here, which is impossible. So Robinhood's kind of weird with that. And then I took out all my money except $5,000 because I wanted to do this 5K challenge, which you can see in the short term has not done very well. But I'm still trying to grow this to 25K in 4 years. I think that's reasonable. So whereas, what did the SPY? The SPY in 5 years, what did it go up? 3x, 4x, something like that? In 5 years? Oh no, in 5 years. No, I'm sorry. It 4x in 20 years. In 5 years, it went up 78%. So I'm trying to 5x $5,000 in 4 years, and the SPY went up almost 80% in 5 years. It's disgusting. The SPY makes me sick. Actually, SPY, you can sell covered calls every day. I'm tempted to just buy 100 shares in the SPY and sell daily covered calls against it to see to see if what compounding the premium 5 days a week would look like. 250 trading days a year. Can't remember how many there are, minus holidays. But that would be an interesting experiment. I used to sell covered calls against the SPY when it was Monday, Wednesday, Friday. But I didn't even find out until a month ago that SPY sells covered call option that expired daily. It does pique my interest, but I'm making way too much money with MicroStrategy and Tesla right now and the mining stocks that I just, unless it's just amazing premium and calorie value, it doesn't even pique my interest. So I talked way longer than I intended to at this point, but I'm going to continue to bang the drum on Bitcoin, bang the drum on MicroStrategy, bang the drum on selling covered calls. And it's not financial advice, but I hope some people get something out of it. And it's time to get paid. LFG. All right, be good, y'all.